Hi, this is Justin from Property Vine, and we sit down with Trey Reed from MVB Mortgage one more time, and this time to talk about down payments. You may not need to put down as much as you think to buy a new home, and you can do it without PMI and without breaking the bank. So spend your next 10 minutes with us to hear just what Trey has to say, and I'll see you on the inside.
Hey, we're back again. We've got Trey with us.
Right.
And what we're going to talk about now is a fear that most people have and a huge question around down payments. When I'm buying a house, how much do I actually need to put down? So I'll give you a quick example. I know some folks, especially parents out there who've got their kids living at home with them, right? And, they think that they have to have 20% to put down, or they think they have to save up some huge number or some huge amount of money in order to buy a home. I know you've got some thoughts and some strategies around how much you need to put down, and I want you to sort of dispel the myths, dispel the rumors around, how much money you actually need to put down to buy a home.
Yeah, one of the biggest hurdles out there, and I'll even say misconceptions that people have, is that you need to have 20% down or even 10% down, or if you don't have the 20%, you should just rent, and that's completely false. There's all different kinds of options where you can get a great loan with a great interest rate, better than renting, and you can put as little as 10, 5, 3, even 0% down. In fact, there's even loans where you can put no money down and roll in some of the closing costs. Now, those are niche products for first-time home buyers, et cetera, but they're out there. So when it comes to the minimum down payment requirement, for standard loans, the minimum down payment is 3% down.
Okay.
And you can get a conventional loan with 3% down, and that's loans that are backed by Fannie Mae and Freddie Mac. You can have, and then beyond those, you can get an FHA loan, which is more for people that want to put less money down, 3.5% is the minimum, and they've got credit scores under 700. So that's exactly what an FHA loan is intended for. The interest rates are competitive, and the interest rates really don't get worse when you have credit in the 600s.
So would you say FHA loans are they mostly designed for first-time home buyers, or can anyone get an FHA?
Anyone can get an FHA loan. A lot of people think FHA stands for first-time home buyer or something. No, that's completely wrong. It stands for Federal Housing Administration. So that's another misconception that I see.
Right.
The person that's perfect for an FHA loan is someone that wants to put 3.5% down or around that range and's got credit under 700. If you've got great credit and you still only want to put a little bit amount down, you can get a conventional loan that's going to be slightly more advantageous, and you can put as little as 3% down.
Sorry to interrupt. I promise this will only take a few seconds. If this content is helpful to you, all I ask is that you share it with a friend, coworker, a family member. And if you live in Virginia, Maryland, or DC and are thinking about buying or selling a home, please give us a call. We'd love to help you. Okay, now back to our episode.
So you did mention that there are some loans where you can actually borrow more than 100% of the loan, where you can roll closing costs in and essentially maybe get into a home with nothing.
Nothing, yeah.
So is that smart? Would you say that there are certain scenarios where that does make sense?
I'm sure there's scenarios where it doesn't make sense. It just depends on what your market is. You want to look at what your payments are and what your costs are and compare it to renting. If it's much more than it would be to rent, you also want to take a look at the tax benefits and how much principal you're paying, and compare those options. But a lot of the times, people that want to buy the homes and they can do so where it is advantageous, they can put zero money down. So in Virginia specifically, there's an organization called VHDA. It stands for the Virginia Housing Development Authority. They're a nonprofit located in Richmond, and they're the number one, at least in my opinion, organization for down payment assistance for first-time homebuyers in Virginia. And the way that their programs work, they've really got two programs. They've got a 1% down program where they'll then give you a grant for 2%.
Oh, wow.
So you put 1% down yourself, they'll give you a 2% grant. It's free money. There's no interest. There's no repayment. It is as free gets. And then the other 97% is from the loan. So that's 1% down.
So in Virginia, there's a program where you can actually get money for free towards your home purchase.
Absolutely.
Now, this is for first-time home buyers.
It's first-time home buyers only, and you got to meet some other requirements. There's a minimum credit score requirement, and it's between 640 and 660, depending on your scenario. And then there's an income cap, and that's based on your household income and the county you're in. So if you're in Northern Virginia, the income limits are higher than if you're not in Northern Virginia, just based on, the median incomes in those counties. If you're one or two people in a household, I believe the income limit is 100,000. And then if you've got 3 or more people in the house, so that would include if you had a child, I believe it bumps up to around 120. I don't know the exact number, but it's somewhere in that range, maybe even as high as 130.
Okay. So we're in Northern Virginia in Fairfax County, higher income limits. And I can be a single person, right? I can be a single mom or, someone out of college or in my mid-20s, not married yet to qualify for this VHDA. I can be married as well, right?
Absolutely.
And they'll give you roughly 2% towards your home so that you can get these 3% down, where in that scenario, you only need to come up with 1% of the property.
That's exactly right.
Or 1% of the purchase price of the home.
And they've got another program where you put zero money down, but none of it's free. So you're borrowing all 100% of it. So it's actually better. Even though it's no money down, it's not quite as good as putting the 1% down because you get free money in that scenario. But if you don't have the 1% down, you could do the zero money down.
Yeah, I think 1% is achievable for a lot of folks. And a lot of folks who are sitting here waiting to buy a home probably didn't know this existed. And, they're waiting to get that full 20%. And they've already got the 1%, right? And they could get another 2% for free from the VHDA if they just knew this existed. Right?
Yeah, it's a great program. I've helped dozens of people take advantage of it, and VHDA's helped hundreds, if not thousands. So it's absolutely something to look into.
So I'd be willing to bet there's a lot of folks out there who are thinking they need the 20% down. Maybe they've got 10% down, right? Or maybe they're sort of getting close to it, could jump into one of these loans. But you also taught me, a hack. To get around and to avoid PMI, because I think another big fear for people who are going to put down less than 20 and have, some of these options that you're talking about, then the next fear is, well, does that mean I have to get PMI? Right? And so talk a little bit about, number one, the trick to avoid PMI, and not just the simple, I break it up into 2 loans. You had one very nifty way.
Are you talking about the 19.9?
The 19.9, yeah.
Yeah, so...
And maybe you want to talk about that last, but maybe at least right now, talk about ways to avoid PMI. And if PMI is necessary, is it bad? Is that something that I really need to avoid?
So that's a good question. PMI definitely has a negative connotation. People think that it can be unnecessary and it's got a bad rap. And to be honest, PMI... If you can avoid it, great, avoid it. But without PMI, you'd have to put 20% down in most scenarios. So it's a great thing that PMI is around, and it's tax deductible up to a certain income limit. And the ways to avoid it, one is that you mentioned you could do 2 loans at the same time. So basically you get one loan equal to 80% of the value of the house. And so that means that you would just get a second loan for additional piece. So you could do what's called an 80-10-10. Put 10% down. So the first loan is 80%, then you get a second loan for 10%, and then you can do your own 10% down, or you could do an 80-15-5. That's one way to avoid mortgage insurance, or you can roll it into your interest rate, which is a good way to go. Now your interest rate's going to be a little bit higher, but usually that increase in interest rate is less than the amount of mortgage insurance you were going to pay. And when you roll it into the interest rate, it's more tax deductible because it's mortgage interest.
Right.
Where if you're in a certain income cap, mortgage insurance may not be tax deductible.
Especially if I'm single, that's probably really helpful.
It's a good way to go. If you're single, yeah, that could be the case. But it's a really good way to go if you don't think you're going to have the house for that long. Because when you roll the mortgage insurance into the rate, once you get to 20% equity, nothing happens. Your rate is still what it is. But if you were to pay that mortgage insurance separately on a monthly basis, it would go away when you reach 20% equity. So you want to look at how long you plan on owning the house to determine how you want to structure your mortgage insurance. It's a huge piece in figuring. You can roll it into your loan. You can do all different kinds of things.
And so, maybe there are some folks out there who actually have the 20%, so there's folks who don't have the 20 and thought they needed it, but, you don't. You can actually purchase a property right now, and your payment would probably be a lot lower than you think, based on some of these strategies that you're talking about and instruments that are available, financial or loan products that are available. Products is a better word, right? But for those people who, maybe they were able to store up enough cash and they've got that 20%, you told me a nifty trick that maybe you should not put down 20%. to get a lower rate and have a better, loan payment throughout the life of the loan. So talk about that trick.
So yeah, it's something that's hot right now. And I don't think big banks are offering it. It's usually smaller, more local companies like I work for that are offering it. But yeah, it's to actually not put 20% down. It's actually to put 19.9% down, or just a shade under 20% down. And the reason for that is, and it's not intuitive, but the reason is because when you put less than 20% down, yes, mortgage insurance comes into play. But what most people don't realize is that mortgage insurance, you can have it removed once you've reached that 20% equity. So if you put 19.9% down, you're going to reach that 20% equity after just one mortgage payment, and you can have that mortgage insurance removed. A lot of people think that you need to have it for 2 years or there's a minimum time period. That's not the case at all. So when you put 19.9% down and you've got that mortgage insurance, your loan's now insured. And since there's insurance on your loan, it's less risky. And
seems safer to the big banks.
Fannie, Freddie, and we can actually sometimes get you a lower rate. And if it's not a lower rate, it's some sort of lender credit. So maybe it's a half a point towards your closing costs, which could be a couple grand.
Right.
So I've done it dozens of times, and it's a great little trick.
Worst case scenario may be you're able to get $2,000 back, but maybe you have one payment where you've got to pay mortgage insurance
of $50.
$50, right?
So you pay $50 one time to get
to make
$2,000 at closing.
Right, to get $2,000.
You're gonna do that every time.
Would you give me $50 if I gave you $2,000?
Yeah, exactly, exactly. And sometimes it is getting a lower rate.
Yeah,
it just depends on the scenario. Every scenario is different, but it's a great little hack. So there's a lot of people out there that they're putting the 20%, and maybe they should just put 19.9 and take a little benefit.
Yeah, I love that trick, man. I love that, and that's just talk to a loan officer, talk to someone who's in the game, like Trey, who is every day just studying the stuff inside and out. I'm a big proponent of specialists. I don't believe in generalists. Even when I'm building my business, I won't get the person to consult me who knows a little bit about everything. I'm going to find the person who knows that specific thing extremely well. Mortgages extremely well.
Thank you.
I appreciate that, man. I appreciate, this knowledge that you're giving people who follow us. And just excited that they can use this information and apply it. So, we dispelled the myths around the 20%. Sometimes maybe it doesn't make sense to even put 20% down. Not only that, you don't really need 20%. You can walk in a property with 1%, get 2% for free from Virginia if you qualify for this loan product that you talked about, or this program.
Yeah. I've got a buddy that actually just bought in the last 6 months. He put zero money down using the VHDA option. He lived there for a year himself, and then he had a couple extra bedrooms open. He has 2 buddies move in with him, helping him pay the mortgage, and I think he's only paying maybe $700 of his $2,000 mortgage payment, and he got in with zero money.
Wow.
It's beautiful.
Okay. So if anyone out there is listening and to this specific podcast, and they are interested in, how quickly you can get into a property because you thought that you needed more money than what Trey is talking about here. You thought you actually needed 20% and you didn't. You have any questions about it, just give us a call, drop a line.
Absolutely.
Reach out to Trey on his Instagram. It's at Trey Mortgage. Is that
Trey
right?
Reed Mortgage.
At Trey Reed Mortgage. And Reed is REED. So at Trey Reed Mortgage on Instagram. Be happy to talk to you about it. Trey, thanks for coming back and telling us about, dispelling the rumors and the myths around, this whole down payment question. I know a lot of folks have that question. So it's always a joy and pleasure having you here, man.
Yeah. Thanks, Justin.
All right.
All right.